A very good morning, friends. So I hope you're all doing well, and I guess I get some inputs from my friends as well. Good morning, sir. Happy to see you after class of Index 8 and 10. Well, I'm also very happy to see you back. And this time we have got some very interesting standard. Almost you can say for the next 10 classes, we have got a very important and an interesting standard. A plethora of standards, I would say, which is going to cover the concept of consolidation. So today we're going to start with Index 103, and the name of the standard is called business combination. No worry, I'm not going to presume any kind of background on your part as far as this standard is concerned, because in any case, this standard is absolutely new, because once you've done your intermediate, you've never been exposed to this kind of a standard, so there is no presumption on my part that you would be knowing anything. We'll be starting from the very scratch. But I guess before we start further, I would just like to, give you some inputs at this stage, rather advice and I think request something at this stage. Now, since it's a little longer standard and a little more complicated standard, and also very important from the examination point of view, I think your consistent efforts in terms of revising the standard each class by class is also going to be very important. Because what happens when there are so many nitty-gritties involved in a particular standard, you tend to forget the small little intricate points on those particular standard. So, of course, I'll also make an effort where we can keep consolidating things in between. Like, for example, as I am done with the session today, towards the end of the session, I'll try to give you a quick recap of the concept as well, so that you can consolidate your learnings. But I would also, request that once the class gets over, before the next class, you must also make a conscious effort in terms of revising the content as well. So I think on that note, let's, begin the journey. So good morning once again to each one of you once again. So let's begin the journey. I am starting with the concept of Ind AS 103, which is called business combination. So as you can see, the name of the standard business combinations and the number of the standard is called Ind AS 103. The very first question what comes to the mind, because whenever I also look at any standard for that matter, the very first question what comes to the mind is, what is a business combination? So I think let's first of all work upon that. Then I'm going to give you a step-by-step approach in terms of deciding whether we are under the purview of this standard or not. So I think let's begin the journey. Let's consider a very simple example to understand. Watch this very carefully, because this is going to create a base for the understanding of this standard. Now, let's imagine there is a company A Limited, and let's imagine there is a company B Limited. Now, this example would remind you, what you've done at your intermediate levels as well. Now, let's say, for example, A Limited acquired the business of B. So I would rather say that, let's say A acquired a control over the business of B Limited. I'm very consciously using the two terms. I'm saying A Limited acquires a control, term number one, over the business of B. So we're looking at A gets a control, number one, over the business of B. Then technically, I would say that A Limited is called acquirer. A Limited is called acquirer company, and B Limited is technically called an acquiree company. So we can say that if A gets a control over B, that is control over the business of B, we would technically say that A is the acquirer company and B is supposed to be the acquiree company. Now, the two questions what comes to the mind is, when I say that A gets a control over the business of B, what do you mean by control and what do you mean by business? So let me tell you one thing. When I say control, the concept of control generally, mind the words, I'm saying the control generally stems out of the fact that A has got more than half of the voting power in terms of B. Well, let me tell you that control under Ind AS is not a rule-based assessment. We cannot say that if A has got more than 50% voting power in B, it does not necessarily imply that A controls B. We'll be seeing later when we come to the control standard, the consolidation standard, Indes 110, which makes it very clear that the control assessment is a principle-based assessment and not a rule-based assessment. But for the time being, let's consider that when you say A gets a control, we can say generally when A gets more than 50% voting power. I did not say 50%. Mind you, I said he gets more than 50% voting power. In order to control a company, you got to get more than 50% voting power in a company. So if A gets more than 50% plus voting power, as far as B Limited is concerned, I would say A gets a control on the business of B. The next question what arises is, when I say A gets a control over the business, what do you mean by the word business? Well, Index 103 gives us the parameters in terms of deciding when it is supposed to be a business. And one thing which I would definitely like to say, if you acquire a single asset from someone, it can never be a business for sure. And if you acquire a group of assets, maybe with or without liabilities, it may be a business. Mind each and every word of what I'm saying. So if I acquire a single asset from B, it can never be a case of business. But if you acquire a group of assets, it may or may not be a business. It is not necessary that if you acquire a group of assets with or without liability, it necessarily means it's a business. It may or may not be a business. So Index 103 gives us the parameters in terms of deciding when we would say it is a business. I think let me consolidate the picture. I know we have started on a very technical note because the standard itself is slightly technical, but trust me, if you go to hear things carefully, I will be able to give you a very good grip on the standard. Terms and conditions apply. Okay, let's consolidate the picture. We said that A gets a control over the business of B. There are two parameters. So one is that A gets a control, one, and the control is over the business of B, there is two. A will be called as acquirer company and B will be called as an acquiree company. Now, in this particular case, when you look at the concept of control, generally, as per Index 110, the control generally comes when A gets more than 50% voting power in terms of B. Though it is a principle-based assessment, we'll see the details of assessment of control when we come to Index 110 in detail. Next, when I say the word business, I very clearly said that if you acquire a single asset from someone, it can never be a business. And if you acquire a group of assets, maybe with or without liability, it may turn out to be a business. Index 103 has given a certain kind of test, which we'll see very soon, which will help us in deciding whether the group of assets is a business or not. But once you establish that A gets a control over the business of B, I would say in the books of A, I'm saying in the books of A, we will have to trigger 103. So once you establish the control, I would say Index 103 will get triggered. So Index 103 gets triggered when you establish a control over the business of another entity. So if A is able to establish a control over the business of B, then A would trigger the concept of Index 103, and we are going to see how the accounting of this acquisition, we're going to see how the accounting of this acquisition will be done in the books of A. Index 103 does not focus on the accounting of the acquiree. Index 103 focuses on the accounting in the books of the acquirer. So we would see that, okay, if A gets a control over the business of B, which also means that B is become a subsidiary, which also means that B is become a subsidiary, how would A account for the control over the business of B in its financial statements, in its books of accounts? And that is what Ind AS 103 deals with. I hope I am pretty clear, friends, at this stage. I guess you got the basic point clear. Okay, that's wonderful indeed. Now, to make your life very simple, what I'm going to do, this very basic concept, I am going to segregate into a simple three-step model. Because I think we need to be very clear on situations that in which permutation combinations, which standards is going to trigger. So before I take the journey on Ind AS 103, what I'm going to do, since we're going to cover a plethora of standards, starting from business combination to consolidation standards, let's get connected in terms of which situation, which standards would apply. Right? Okay, I think I've got a question. Shruti, you said any other Ind AS covers the books of inquiry? Well, yes. As far as books of inquiry is concerned, no. The focus out here is not on the books of inquiry, because inquiry in any case will be making its own standalone financial statements by virtue of the relevant Ind AS. Here we are looking at the person who gets a control over another company. Because the moment you get a control over another company, in that particular case, you will say the investee company B is my subsidiary. And if that company becomes my subsidiary, we are more concerned with the accounting in the books of A, not the books of the subsidiary, but the books of the parent. Right? I guess you got your answer on that. Okay. Now, to make it very clear, I am going to give you a three-step model, as I said. So it will be very crystal clear in which combinations, which particular standards are going to trigger. So I think let's start the journey. So you can maybe start writing this as well. So I am giving you a simple three-step model. This will help you to get a very clear understanding of which standard is going to trigger at which particular permutation combination. So let me start the journey and let me first give you the combinations, and that is step number one. See this in a very logical manner. So we're going to start a journey with step number one. As an entity, as an acquirer, I am going to first of all put across a question to myself, what did I acquire? It is very important to understand that what did I acquire? Now, I might acquire, let's say, an individual asset, or I might acquire a group of assets. Now, why I'm looking at what did you acquire? Because if you acquire a single asset or an individual asset, it can never be a business. And if it is not a business, then Ind AS 103 undoubtedly would not apply. So the very first focus you're going to put across to yourself is, what did we acquire? What did we acquire? So I think that's the very first focus we're going to put across to ourselves, that what did we acquire? Underline the word, what did we acquire? Now, I would say that when I put across this question to myself, that what did I acquire? I would say it could be a case of a single asset. I would say it is a case of either a single asset, or I would say it is a case of acquiring a group of assets. Now, mind you, when I say group of assets, it doesn't mean that it is only a group of assets without liability. When I say a group of assets, it can be with or it can be without liability. I'm not putting it, but it is implied that it could be with or without liabilities as well. Now, if you say that you acquired a single asset, now, one thing is very clear, it cannot be a case of 103. It cannot be a case of Ind AS 103. In this particular case, you will put across another question, and that is that single asset supposed to be a tangible asset? Or is that single asset supposed to be an intangible asset? Now you're going to see a lot of other standards what you've covered is going to get connected at this particular stage. I think let me take the liberty of asking you, if you acquire a single asset which is tangible in nature, what do you think would be the triggering standard? If you recall, you would have done three standards on non-current assets. One is a PPE, that is Ind AS 16. One is intangible asset, that is Ind AS 38. And one is investment property, that is Ind AS 40. Would you like to make a guess and decide that if you acquire, let us say, a tangible asset, then which standard would trigger? And that's very rightly said. So in this particular case, we can say if it is a tangible asset, there could be a triggering of Ind AS 16 or Ind AS 40 as the case might be. It could be a property, plant, equipment, or it could be a case of investment property, depending upon what kind of parameters are met. Wow, that's wonderful indeed. Okay, and I think you can definitely decide that if it is intangible assets in nature, then in this particular case, Ind AS 38 would apply, which talks about the concept of intangible assets. Simple and straight. Which means once you reach the focus and you're able to decide that we acquired a single asset, it cannot be a case of 103. Depending it is tangible or intangible in nature, you would apply 16 or 40 for tangible, and you would apply 38 for intangible asset, which you've already covered in terms of ICAI. Now, the moment you say that yes, it is supposed to be a group of assets, the moment you say that it is supposed to be a group of assets, I would say let's go to step number 2. Because it is not necessary that the group of asset is supposed to be a business. So what we'll do in this particular case, we go to the step number 2. And trust me, when you're cracking things on a step-by-step approach, it is very easy to chronologically remember as well what do you need to ask yourself at each stage. Okay, so with this input, let's go on to the step number 2. So once you've identified whether it is a single asset or it is a group of assets, once you say it is a group of assets, then we go on to the step number 2. Now it is time to decide. So is the group of assets the time to decide that is the group of assets? Underline the word group of assets. As I've already clarified, it could be with or without liability. So is the group of assets a business? And circle the word business. We need to now put across a question that is that group of assets supposed to be a business or not? As I said earlier, Ind AS 103 is given us the parameters in terms of deciding whether it is a business or not. Now, let me give you a little more technical inputs at this stage. There are basically two tests which helps us in deciding whether a group of asset is a business or not. Don't worry, we'll document some notes, but just hear me first carefully. The first test is called a concentration test. I call it as CT. It's not a CT scan, but it's like a CT scan. We call it as a concentration test. So there is a test which is called a concentration test, that is called CT, which helps us in deciding whether it is a business or not. But this concentration test is supposed to be optional in nature. So we'll see the concentration test a little more detail a little later after the 3 steps are over. But the standard gives me a test called a concentration test, but this is optional. The entity may choose not to apply the concentration test in order to determine whether it is a business or not. But then there is another test which is called, I call it as IPO. It's not called an IPO test, mind you, but I call it as a nickname called IPO. That's called input process output test. And this is a 3-element test. We technically call it as a 3-element test, but I prefer to call it as an IPO test. It's not the initial public offer. It is called the input process and output test. This IPO test will help you to identify whether it is a business or not, and it's mandatory. And it is mandatory. Which means, as of now, you just need to remember one simple thing in the mind, and that is, in order to decide whether a group of asset is a business or not, we are given two tests. We'll come to these tests in a discussion, in a detailed discussion very shortly. But there are two tests which are there. One is what we call the concentration test. One is what we call the concentration test. And the other one is what I call it as IPO test, and that is input, process, and output test. How these tests are conducted, we will understand this very shortly with you. But for the time being, just remember, this concentration test is completely optional in nature. It is a choice of the entity. That means A gets a group, acquires a group of assets from B. Now it's a matter of choice for A whether it wants to apply a concentration test or not. But when it comes to an IPO test, it is undoubtedly mandatory in nature. So even if you don't choose to apply a concentration test, you have to, on a mandatory basis, apply the IPO test in this case. So basically, these two tests will help us in identifying whether a group of asset is a business or not. Okay. Then once you've conducted these tests, now you would put across a question that is the group of assets a business? The answer either comes no or the answer comes a yes. So the answer either comes a yes or the answer comes a no. After applying these particular tests, you decide that is it group of asset a business or not. Now, very carefully at this stage, once you say that it is not a business, one thing is very clear, that Ind AS 103 is not applicable. So one thing is very clear, that Ind AS 103 is not applicable, but Ind AS 103 gives you a guidance in terms of when a group of asset is acquired and is not a business. I put it again. If you say that it is a group of assets which is not a business, 103 is not applicable, but 103 still gives you a guidance how the accounting is done in this case. It's very simple. We'll do a practical example also very soon after the three chart gets over, how the guidance of 103 is done. It is like acquiring two or more than two assets together. Because if you're acquiring a group of assets, which you say is not a business, it is acquiring two or more than two assets put together and paying a consolidated consideration. So what do you need to do in this case? The consolidated consideration has to be split between the various assets. Because it is like you paid a consolidated price, and that consolidated price is paid for the collective assets, the group of assets. So the objective is to allocate the consolidated consideration to the various assets which has been acquired as a group. So Ind AS 103 tells me that you will allocate the total consideration, you will allocate the total consideration in the ratio of relative fair values. You will allocate this total consideration. So whatever is the total consideration paid, the total consideration paid is to be allocated in the ratio of relative fair values. How do we do that? Don't worry, I'll take an example very shortly to explain how this is done. So the moment you say it is not a business, 103 is not applicable, but this guidance is given in 103 that the consideration paid in totality is to be divided, allocated to each and every asset in the ratio of relative fair value. Don't get worried on what is a relative fair value. We'll come to the discussion. Okay. If you say a yes, then I am supposed to go to the step number 3. If you say yes, it is supposed to be business, then we are going to go to the step number 3 in this particular case. Okay, I think Shruti, you said Consideration is mandatory to be paid in consolidation only, then the guidance would be applied. Well, I am not talking of the consideration at the moment. I'm only talking of a concentration test. Let's not talk of the consideration at the moment, because we'll be discussing the concept of the purchase consideration in detail when I come to the concept of acquisition accounting. So no worries on that. Okay. So this is my step number 2, where you're looking at a group of asset is supposed to be a business or not. If not, you pay a consolidated consideration to be allocated between the various assets in the ratio of fair value. And if you say yes, it is a business, you go to the step number 3. Okay. Then comes my step number 3. I very carefully, drafted these steps so that it gives you a very fair idea on a step-by-step approach, to decide which standard is going to apply. Now, the third step is a little more crucial, because this is now going to give you a lot of permutation combinations. Don't worry. After that, I'm going to consolidate the learnings. I know what we are speaking today is going to be slightly more technical, because the level of the standard is, a little complicated. But at the same time, it is very interesting. And if you're able to understand on a logical perspective, trust me, it is very easy to apply. Now, in terms of step number 3, the next question we need to say, did the acquirer, the next question is, did the acquirer acquire, control, and circle the word control, over the business of, did the acquirer get a control over the business of acquiree? So the next focus question is to put across, did the acquirer, in my example A Limited, get a control over the business of acquiree, in my example B? The focus is control. I've already told you that as far as control is concerned, the control will be assessed on the basis of Ind AS 110. For the time being, we said the control comes when you get more than 50% voting power in a company. So we said in step number 1, did you acquire a group of assets? Yes. Is it a business? Yes. Did you get a control over the business? Yes. Look at the focus in terms of the 3 steps. The focus in step number 1 is, did you acquire a group of assets? And the focus is it a business or not? And then you're saying, did you get a control over the business or not? So here again, there will be 2 permutation combinations. So when you put across a question, did you get a control? The answer is either a yes, or the answer is either a no. Now watch me carefully, friends, because there are going to be a lot of permutation combinations of standards which will trigger on a yes and no. If you say a yes, there are going to be, please hear this carefully, there are going to be 3 standards which will trigger. If you say a yes, there are going to be 3 standards which will trigger. Number 1, you will trigger Ind AS 103. This is only triggered once. This is triggered only once. A gets a control over the business of B. Ind AS 103 is a one-time application in this transaction. Mind it. If A gets a control over the business of B, 103 is a one-time application. Only once it'll apply for A in that transaction. It is not going to be applied again and again. It is only applied once when the control of the business is done. So this standard will trigger only once. Next, the company will be required to make a separate financials and a consolidate financials. The moment you get a control over the business of another company, you establish a parent-subsidiary relationship. And the moment you establish a parent-subsidiary relationship, it becomes a related party. So A gets a control over B, A becomes a parent and B becomes a subsidiary. So A establishes a parent-subsidiary relationship. It is a related party. Now, A will be required to make two financial statements. One is a separate financial statements, which you can say more or less is like a standalone financials of A. And one is he would be required to consolidate the financials of B along with A, because it is going to present the financials incorporating the results of B as well. So A would be presenting a separate financial statements that would be as per Ind AS 27. And A would also be presenting a consolidated financial statements that is as per Ind AS 110. And this is going to be done every year. This is going to be done every year by year. This is not a one-time application, but it's going to be done year by year. So three standards would trigger. Three standards would trigger once you establish a control over the business of B: separate financials 27, consolidated financials 110, and of course, one-time application of the standard 103. Trust me, this is the only situation when Ind AS 103 gets triggered. And since now, for the May 24 examinations onward, you're also going to get MCQs and all. It is very important that your conceptual clarity is at the highest level. You should be very clear in terms of which combination triggers what, because these kind of inputs is also going to help you in cracking those MCQ questions as well. Okay. So far, so good. Let me just see if there are any questions coming in between so far. No. Okay, that's great. Don't worry, we'll consolidate the picture again. Now, if you say a no, watch this carefully. If you say that A did not get a control over the business of B, then the possibilities are, and you are going to apply these possibilities one by one. So when you say that A does not get a control, there are various possibilities which can arise. There are various possibilities which can arise if A does not get a control. We can say maybe he gets a joint control. Maybe he gets a joint control. That means A along with another investor, mind the words, A along with another investor gets a joint control over B. He doesn't individually control B, but A along with another investor, let's say C, gets a joint control over B. Or maybe if not a joint control, he gets what we call a significant influence. So maybe in this particular case, he gets a significant influence. Now, to assess the concept of a joint control, Ind AS 111 is evaluated. In order to see whether A gets a joint control over B or not, you got to evaluate with the help of Ind AS 111. If not, this is going to be in a sequence. If not, then you check, does he get a significant influence over B? The significant influence is assessed on the basis of Ind AS 28. So this is to be done in terms of a sequence. You cannot say, let me check the significant influence first. You need to check this in a sequential order. First, you see, do you control? If no. Do you have a joint control? No. Is there a significant influence sequentially to be applied? So you would say that, okay, is there a joint control? If not, is there a significant influence? If not, then maybe you're just acting as a passive investor. Then maybe you're acting just as a passive investor. So you need to see that if there is a joint control, if not, is there a significant influence? If not, are you a passive investor? Now, for your understanding, let me tell you, when you say a joint control, let's say there are two parties, it could be 50-50, for example. I'm not saying it's always going to be 50-50. Let's say if there are three people, there are three investors, let's say they've got 1/3 each. So this is a joint control, that two or more than two investors jointly control the investee company. When I say a significant influence, generally it means 20% or more. Generally it means 20% or more, but up to 50. but it is up to 50%, because if it is more than 50, because if it is more than 50, it becomes a case of control. So you can say if it is like equal stake of the investors, joint control. If it is supposed to be 20% or more than 20%, but not more than 50, up to 50, it could be significant influence. A passive investor is below 20%. Anything which is below 20% generally would become a passive investor. Now, once you are able to say, now let me give you the application of the standards. So once you're able to say that in this particular case, there is a joint control, none of these cases 103 would apply. None of these cases 103 would apply. So in this particular case, again, you need to present two financial statements. One is separate and one is consolidated financials. If you get a joint control, then it establishes a related party. If you say a significant influence, you establish a related party. But if it is a passive investment, no related party is established. So if it is a joint control for separate financials, Ind AS 27. For consolidated financial statements, Ind AS 111, or could be 28. Or could be 28, we'll see those details later. If it is a significant influence, again, separate financials 27 and consolidated financials 28. So since it is a related party, you will have to apply a separate and a consolidated financials. 27 for separate financials, 111 for consolidation for joint control, and it is 28 for a significant influence. Now, if you're a passive investor, no separate, no consolidated financials. No separate, no 27, no 111, no 28, no separate and consolidated financials. In this case, you would apply simply Ind AS 109 to the investment which is made. You've already seen, no, you're yet to see, you'll be seeing the financial instrument standards, where in the financial instrument standards, an unrelated party investment. An unrelated party investments is accounted under Ind AS 109. If you get less than 20% stake in a company, it's an unrelated party investments and 109 applies. So, in the last half an hour, 35 minutes, you've given us so much of data to absorb. Can you please do a little consolidation of whatever you have said so far? I'll do that. I'll do that. Let me first check in the meantime if there are any questions, then I'll consolidate and take it further. Oh, by the way, I think I'm getting good answers already. Wow, that's interesting indeed. So I think many of you got good answers to give already. Wow, that's great. So I think let me first consolidate the picture, then tell you what are the two agendas what we're going to discuss. Let's go back and let's consolidate the picture. Now, in the meantime, I think I want you to first of all also give me input, since we're meeting after a long time. I just want to get a little understanding in terms of, I guess, a pace is going good. So do let me know if the pace is good. I hope I'm not very fast. I hope I'm not very slow. The pace is good. We could accordingly, manage the speed. And of course, also give me the inputs if you're comfortably clear with the concept so far. I've just given you a background in terms of application of Ind AS 103. So before I consolidate, just let me know your inputs in terms of the speed factor, what we are going with, and also in terms of your understanding so far. All good to go, is it? Okay. Now, let me take it further. Yes, sir, it is great, all good, wonderful indeed. That is superb. Okay, now let's consolidate. Let's ask you a few questions as well. I started my journey on Ind AS 103, in which case I said A gets a control over the business of B, then 103 could trigger. The two important aspect is control, and the second important aspect is a business. When you say that A gets a control over the business of B, then only 103 can trigger. So what I did, in order to give you a very deep understanding of the triggering conditions for the standard, I simply gave you a three-step model. So your focus in step number one is what did you acquire? The focus in terms of step number two is if it is a group of assets, is it a business or not? And the focus in terms of step number three is did you get a control over the business? So the very first step, you need to see what did you acquire? One thing is very clear that if you acquire an individual asset, it can never be a case of 103. So if somebody tells me that A gets an individual asset, I would say it can never be a case of 103, depending upon it's a tangible or intangible assets. You would apply 16 or 40 for tangible, and you would apply 38 for intangible asset. And these are normal standards which you've already covered. Then the focus goes on to the step number two. If you say, no, it's not an individual asset, it is a group of assets with or without liability, you need to be clear that it should be a business before 103 triggers. So you need to make an assessment whether a group of asset is a business or not. So I need to teach you another concept, how to decide a group of asset is a business or not. So my next focus of discussion is the concentration test, which is optional, and the IPO test, which is mandatory. What is that concentration test and what is that input process output test, which helps me to decide the step number two. So we are going to focus on this area, that is the evaluation whether it is a business or not. Once you apply these particular tests and you say it's not a business, one thing is pretty clear, 103 is not applicable. Now, in this particular case, what is happening? You are acquiring a group of assets and making a consolidated payment. So what we need to do, we need to basically split this consolidated payment between the various assets acquired. And the simple mathematics is what 103 tells me, that you will allocate this consideration in the ratio of relative fair value. I'll do a question with you immediately after this. So that is another area pending. I need to give you how the application, the guidance of 103 applies when it is not a business. So we need to understand how to assess a business, one, and we need to understand the application of this allocation part. So once you decide in step two, it is a business, then the plethora of permutation combinations would arise. And in this particular case, you need to see, did you get a control over the business of acquiring? If you get a control, there are three standards which trigger 103 for sure. And this is only a one-time application. 103 applies only once. And then every year, a separate financials, 27, a consolidated financials, 110. And if you do not get a control, there could be different permutation combinations, but you need to go on a sequential order. First, see, do you get a control? If not, do you get a joint control? If not, do you get a significant influence? If not, are you a passive investor? These questions need to be checked in a sequential order. A control means a related party. A joint control means a related party. A significant influence means a related party. So in all these cases, separate and consolidate financials apply. You would notice Index 27 is a common standard whenever a related party is established. If there is a control or there is a joint control or there is a significant influence, Index 27 triggers for a separate financials of A. But if there is a control, consolidation 110. If there is a joint control, consolidation 111. If there is a significant influence, consolidation 28. But if there is no control, no joint control, or no significant influence, you're simply a passive investor. If you're a passive investor, it's an unrelated party. And if it is an unrelated party, no separate, no consolidated financials, simply financial instrument standard Index 109 would apply. Okay, that is great. The pace is perfect, all good. Clear, sir, your three-step model makes it easy. Thank you so much. Wonderful indeed. Okay, so now there are two focus points which we need to concentrate. One is allocation part and one is the business test. So let's do one thing. Let's go on to the illustration number one, which is given in the study material. Let me know if this is clearly visible, friends, to you. If this is clearly visible to you, or do you want me to zoom it further? If this is pretty visible, then I think we can get started. Okay, so let me just read out to you. This is illustration one in the study material. I'm looking at the illustration number one in the study material. Let me read. It says an entity acquires an equipment and a patent. I want to ask you a few questions as I read further. Did you acquire an individual asset or a group of assets? It says an entity acquires an equipment and a patent. You've acquired a total of two assets. So I would definitely say that it is okay. We want to zoom it further. Okay, not an issue. Let me zoom it further. Let's do one thing. Let's zoom it further so that is clearly visible. I guess now it should be pretty good. Okay, I think it should be pretty good to watch now. Yes. So that's wonderful indeed. You rightly said that it is supposed to be a group of assets. Great. So we said an entity acquires an equipment, that is one, and a patent, that is two. So one thing is very clear, it is a group of assets. I'm applying my three-step model in terms of deciding things. What did I acquire? I said I acquired a group of assets. I now need to see, is it a business or not? It says it is acquired in exchange for 1,000 crores cash and land. So I acquired two assets and I gave cash and I gave a land. Then he says the fair value of the land is 400 crores and the book value or the carrying value of this land is 100 crores. The land which I gave had a book value 100 crores, but a fair value 400 crores. It says the fair values of the equipment and the patent are estimated to be 500 and 1,000 crore respectively. The equipment and patent relate to a product that has just recently been commercialized. The market for this product is still developing. Assume the entity incurred no transaction cost. When I say transaction cost, it means that there is no brokerage, etc., which might have been paid. So no incidental cost has been incurred in acquisition of these assets. For the ease of convenience, the tax consequences on the gain has been ignored. How should the transaction be accounted for? Well, at this particular stage, since I've not given you how do you decide whether a group of asset is a business or not, I may not be able to tell you at this stage in this illustration that whether it is a business or not. So let's presume. Though once you understand the parameters of evaluating a business, you will be able to reach a conclusion easily that this is not a business. But let's consider for the convenience that it is not a business. Let's consider that it is not a business because you will see very clearly later that for a business, there are certain elements which are necessary. And in this particular case, we'll be able to easily prove it's not a business. So just assume for the time being, it's not a business. So I applied my step number one. What did you acquire? I said a group of assets. Let's go to the step number two. Is it a business? No, it is not a business. So 103 cannot apply. So in this particular case, what you're doing, you are paying a consolidated consideration. Now the question arises, what is the total consideration which I am paying? Let us see what is the total consideration I am paying in this particular case. Well, when you look at the consideration paid, I guess it would remind you the parameters in terms of Ind AS 16. When you say that I have paid something, I gave an asset to acquire another asset, then what do you consider? So we consider the fair value of what we gave. Correct? Because when you say that you are exchanging assets, you're acquiring a patent and an equipment, and you are giving a land and a cash. So I would say the consideration is equal to the fair value of what I gave. He's very clearly told me the fair value of the land is 400 crores. So I gave a land which has got a fair value 400 crores, and I also gave a cash to the extent of 1000 crore. So we can say the total consideration paid is 1400 crores. The cost of acquisition of the patent and the equipment is equal to the cash given 1000 and the fair value of the land given, that is 400. So this is the total consideration given. You need to divide this consideration in the ratio of fair value of what you acquired. Now, he's very clearly told us that the fair value of the equipment and the patent is 500 and 1000. So what we'll do, we'll divide this consideration in the ratio of 500 is to 1000, or you can say we're going to divide this in the ratio of 1 is to 2. The total consideration is to be allocated in the ratio of fair values between the two assets. And if I divide this in 1 is to 2, so 1400 divided by 3, it comes to, you can say, 467, and it comes to a total of 933. So we have divided 1400 crores in the ratio of fair value, and this is the ratio in terms of equipment and in terms of patent. So this is the value at which the equipment and the patent is going to be recorded. Now, let's see the entry. So we are fighting. Hear this carefully. What we're doing, we are following the guidance of 103 to allocate. We're using the guidance of 103 to allocate, but at the end of the day, I am doing the accounting as per Ind 16. Because when you exchange assets, then you say that the consideration paid is equal to the fair value of what you gave. Now, let's have a look at the journal entry very carefully at this stage. I think let me just take a little space further and add the entry. So let's see what is the journal entry which I am going to pass in this particular illustration. Just to give you a clarity of thought, what is the journal entry which I am going to pass? Can I say in this particular case, we acquired an equipment. So equipment will be given a debit, and we acquired a patent. The patent will be given a debit. And we've already calculated the values at which they will be recorded. So 467 for the equipment and 933 for the patent. This is the value at which the two assets are recorded. We paid a cash. We give a credit to the cash to the extent of 1000 crore. And we also gave a land. But remember, the land is not to be recorded at the fair value. You need to de-recognize the land in the books of accounts, which is at a book value. And if you go back and see what is the book value of the land, the carrying value is supposed to be 100 crores. So de-recognition is taking place at a book value. This is based on the allocation in the ratio of fair value. And this is the book value. And we'll see that there is a difference in the entry as well. So if you take the sum total on the debit side, it is 1400. Credit side is 1100. We're getting a balancing figure of 300 crores on the credit side. And this is nothing but, you know it. It is supposed to be a gain arising on exchange, what you do as per Ind 16. So there is going to be a balancing figure, which is a gain on exchange of the assets. And this gain on the exchange of the assets ultimately is going to be taken in the profit and loss account itself. Simple and straight. So I think we've answered the requirement of the question. So it says, how should the transaction be accounted for? The only presumption which I've taken in this illustration is presuming it's not a business. But why did I presume that? You will get a clarity once I tell you that what are the parameters of deciding a business. So we decided a 3-step model. It is a group of assets. Yes. It is not a business. No, it's not a business. So we said allocate the total consideration, 1400 crores, in the ratio of the relative fair values of these assets. Now, a question would also arise in your mind that, sir, you said it is divided in the ratio of relative fair value. And you've divided this in the ratio of the fair value. What is the difference between a relative fair value and a fair value ratio? Hear this carefully. In this given example, the two assets are patent and equipment. I am nowhere given in the question that the life of these assets are different. I'm not given that the life of the patent and the life of the equipment is unequal. So I'm assuming that the life of the asset is equal. If the life of the assets is equal, the fair value and the relative fair value ratio is same. But if the lives would have been unequal, you need to consider the ratio of the fair value by making the lives equal. I think I'll not get into that. If you recall, you must have done the concept of, a relative fair value in terms of Index 36 impairment. If you remember, there is a particular illustrations which comes on impairment as well, where unequal life of the asset is there when you do the allocation of corporate assets and you convert the fair values in accordance with the life as well. I think I'll not get into that complication. So remember, if the ratio is to be calculated for unequal assets, it's not going to be simply in the ratio of fair value, but you need to consider the ratio of the relative fair value, which is going to incorporate the life as well. Right? I guess I am pretty much clear on this illustration. Okay. Okay, Shruti was asking the same question. So what is a fair value and a relative fair value? Okay, let me, I think, just give you a little basic insight at this stage. For convenience, just for understanding, let's consider, just for the ease of understanding, let us say the equipment has got a life of 5 years, and let's say the patent has got a life of 10 years. Let's say in this example, the equipment has got a life of 5 years and the patent has got a life of 10 years. You cannot take the ratio as 500 is to 1000. You know what you're going to do? You will say the value of the equipment is 500 and patent will be taken as 2000. Patent will be taken as 2000. I'll put it like this. 1000 with a life of 10 years. 1000 with a life of 10 years. Hear this carefully. 1000 with a life of 10 years is as good as 2000 with a life of 5 years. Equivalent production. So 1000 with a life of 10 years is as good as 2000 for a life of 5 years. So if they had unequal lives, I would have said that let's consider the fair value of equipment to be 500 and the patent to be 2000. I would divide the consideration in the ratio of 1:4. I hope I'm clear. So that is why we use the word relative fair value, because if you need to allocate the consideration to assets with unequal fair values, unequal lives, you need to allocate this in the ratio of relative fair value. Okay. And so you said, so are we going to consider goodwill? No, no, no. When it is a case of an asset acquisition, goodwill never arises. When it is a case of an asset acquisition, no goodwill ever arises. Goodwill arises only in a situation when it is an acquisition of a business. Okay. So this was one illustration which elaborated the concept of group of assets acquired, which is not a business, how the total consideration is allocated to the individual assets in the ratio of fair value. Okay, now let's come to the next agenda with you. I guess, friends, now it's going to be a further interesting point. I'm now going to concentrate on the concentration test. I'm going to concentrate on the concentration test and on the IPO test. Now, hear me very carefully, because what I am going to tell you just might sound a slightly technical, but it is very interesting in the same part. Now, you want me to give you a formula, or you want me to give you a logic of that formula as well? You've got a choice. So decide, you want me to give you simply the formula, or you want me to give you the logic as well? Okay, I think Shruti said, in other words, multiply with the number of years. Yes, you can convert the assets with a higher life into the smaller base. So asset with a life of 10 to be converted to the base of 5. So you can say take a multiplying factor. That is correct. Okay, I guess everybody said so, logic as well. Okay. And if there is a loss, Kriti, what do we do? But if there is a loss, then we're going to put it in the loss on exchange and it enters in the P&L. So whatever will be the balancing figure in this particular entry, whatever is the balancing figure, the gain or loss is going to be simply taken in the profit and loss account. Okay. So I think now everybody wants me to give a logic as well. So I think I need to give you a logic on a concentration test. There is a beautiful example which is given in the study material. This is the example which is given in the study material on how the concentration test is applied. So I think before I take you to this example, we need to understand some basic maths. We need to understand some basic maths. But before this, let me now explain something to you. So please hear this very, very carefully. First, let me create a thought process in your minds. We are deciding whether a group of asset is a business or not. Please hear this very carefully because people tend to get confused on this area and you need to be very clear on the agenda. As I said, there is a concentration test. As I said that there is a concentration test, and I very clearly said that it is completely optional in nature. Meri marzi. I apply this test or I don't apply this test, meri marzi. Now, what's this? So, an entity is got a complete choice. An entity is got a complete choice. They decide to apply the test. They decide not to apply the test. So there are two possibilities. They decide, I am not applying this test. If you choose not to apply this test, you have to apply. I'm putting it very clear. You have to apply IPO test. So if you decide, I don't want to apply the concentration test, you've got a choice, but then you need to apply the IPO test. Now, if you decide to apply this particular test, then you may either pass this test or you may either fail this test. So you may either pass the test or you may either fail the test. If you are going to pass this test, it is not a business. Conclusion is done. The conclusion is done that it is not a business. So if you pass the concentration test, you've decided it's not a business. You cannot apply IPO test. You cannot apply IPO test. So once you've concluded it's not a business, the IPO test cannot be applied. It's a full stop. एक बार जो कमिटमेंट कर दी उसके बाद मैं अपने आप की नहीं सुन सकता. So if you apply the concentration test and you pass this particular test, you cannot apply the IPO test to decide further. You're done, you're sorted. If you fail this particular test, then you need to again apply the IPO test on a mandatory basis. So get this position very clear. The concentration test is completely optional. The different courses of action the company can take. I say, I want to apply the concentration test and you pass the test, concluded it's not a business, you cannot do IPO. And if you fail this particular test, you have to do IPO. Or if you choose that you will not apply this test, then an IPO test applies. So let me create a small little MCQ question to you on a true and false basis. Can I say IPO test is applied only in two circumstances? Number one, you fail the concentration test or you choose not to apply the concentration test. Decide. Let me just give the inputs again. Decide on the true and false. Can I say I am saying the IPO test is applied only in two circumstances. You choose not to apply the concentration test, one, or you fail the concentration test, that is two. Nothing else. Is that right? So the concentration test has to fail or you choose not to apply the concentration test. Only then an IPO test will be applied, otherwise not. Okay, that's great. Okay, so now I think let's go on to the next part with you, and we need to understand the concentration test. Now, let me now understand the optional test, which is the concentration test. I will now explain the concentration test along with the example, but I think first we need to understand. I have divided the concentration test in a three-step model. Oh my God, sir, you convert everything into a three-step model? Yes. I am a little passionate about Indias, and what I've done, I've converted the entire standards into a step-by-step approach. Making it a step-by-step approach doesn't make it, that it's a rule-based standard. It's a logical application of certain steps, which can help you lead to a simple conclusion. Okay, so when you're looking at a concentration test, I am going to apply a three-step model. You need to remember, wherever I'm giving you three steps, triggering this standard, I gave you a three-step model. Now on the concentration test, I'm going to give you a three-step model. Even the IPO test, I'll give you a three-step model. So you will get three steps today. You can say three areas under three-step model. When does the standard trigger? A three-step model. IPO test, a three-step model. Concentration test, a three-step model. That makes life simple. Okay. Now watch the steps very carefully. I'll explain the logic as well, but first look at the steps you need to apply. Just see the mathematical application, then we'll see the logic. Now, the first thing what you need to do, you need to calculate the gross fair value of assets. The first thing what I need to do in step number one, you need to calculate a gross fair value. The word is gross fair value of assets. So you need to calculate, first of all, the gross fair value of the assets. Don't get worried on the logic. I'll explain the logic, but see how I'm going to calculate this. In order to calculate the gross fair value of the assets, what I will do, I will take the purchase consideration, and to the purchase consideration, I will add the NCI, and I will add the PHI. Don't get worried on the terms. I will explain everything. Just look at the formula right now. To the purchase consideration, you will add the NCI. Don't get worried on what is NCI. And you're going to add the PHI. Don't get worried on what is PHI. You add these three items, PC plus NCI plus PHI. So you're going to add three things. One is purchase consideration, one is non-controlling interest, and one is previously held interest, PHI. And once you get this figure, we're going to add the liabilities, and we are going to reduce the cash and the cash equivalents. Don't get worried on why are we doing all this. I'll explain. So once you get the figure, you need to add the liabilities and reduce the cash and cash equivalents, and this will give you the gross fair value of the assets. This will give you the gross fair value of the assets. My step number one will be achieved. Then I go to the step number two, and in terms of the step number two, we will evaluate and identify a single asset, or maybe a group of similar assets. We will identify a single asset or a group of similar assets. We will identify a single asset. You will say, sir, which single asset are you talking of? Don't worry. Don't worry. Group of similar assets. And then I will consider the value as per step number two and divided by the value as per step number one. Step number two, and divided by the value as per step number one, and take a percentage. And we're going to get a percentage. Sir, I'm not able to understand any logic of what you said. Don't worry, friends, don't worry. I'm just giving you a formula right now. We'll understand the logic with an example very shortly. So you need to calculate the gross fair value of the assets, and then you need to consider the single or the group of similar assets, And you need to take the value as per step number 2 divided by the value as per step 1 and get a percentage with the help of which we will decide. We'll take a percentage and we will decide on that basis. Okay. So if you have taken a note on this, now it's time to give you an example and give you the logics as well. So let's give you the logics as well on this. And okay, I think Yukta, you said, so false because it is mandatory whether we choose. Oh, my earlier statement was true. My earlier statement was true. Okay. Now let's take an example and let's appreciate this bit. I'm now going to take you to an example. Please watch this very carefully. Please watch this very carefully. You will get this logic in the next 5 minutes itself. Now, please look at this example with a complete concentration. You will understand the concentration test. Let's understand. I'm reading the example and I'll ask you a few things. A holds a 20% interest in B. This is called previously held interest. I call it as PHI. A is already got a 20% stake in B. This is what we call previously held interest. This is called PHI. Welcome back, friends. Sorry, there was a little electricity issue due to which we had to take a little earlier break. But no worries, I think electricity is back on time. Maybe I think I was discussing too technical stuff where I think the electricity authorities also found it too technical to digest. I guess I am audible and visible back, I guess. Right. Do let me know, friends, if you are getting the audio and the video clear, then I think we can start back. Okay, so I think let me first give you quick inputs in terms of what we were discussing. So I was discussing with you the concept of a concentration test, and I've just given you a basic mathematical formula for the time being. I'm yet to explain you the logic, which I'll explain with a practical example to you. And in this particular case, I gave you a simple three-step model where you need to calculate, first of all, the gross fair value of the assets. And then you need to identify a single or maybe a group of similar assets. What does that mean? No worry, we'll see. And then you need to consider the value as per step number 2 as a percentage of value as per step number 1. And based on the percentage, we are going to draw some conclusions. Okay, so I think let's take it further. Good, all wonderful. Okay, so I think let me start back and take you to the example. Now, hear this very carefully. I'm going to now take you back on this example. This is an example which is given in the study material, and I'll give you the logic also very soon. Next 10 minutes, you're going to get the complete logic of the concentration test. Okay, so as I was reading out here, it says A is got a 20% interest in B. Now, entity A already has a 20% stake in B. This is what we call a PHI. It is called a previously held interest. So you already had a 20% stake in the company. Then it says subsequently, A further acquires a 50% share by paying a total of 300 crores. So I can say they already had a 20% stake and they acquired another 50% stake, and that makes it a total of 70. Now, before I read it further, let me ask you a simple question. If I say entity A already had a 20% stake and acquired another 50% stake, that makes it a 70%. Then there is some other investor who's got that remaining 30% interest in that company. And that 30% interest is held by what we call NCI, that's called non-controlling interest. Because A's got a 70% stake in the company, so a 70% stake means that he gets a controlling interest in the company. So naturally, the other investors who've got that remaining 30% is called NCI. So A has got a 70% stake and the remaining 30% is with the NCI. Now, let me ask you a simple mathematical question. I'm going to put across two questions. Think carefully before you answer. I paid a consideration for 50%, 1. I had a 20% stake, which is a PHI 2. And I add the NCI. Does the sum total of the three makes it 100%? That is question number 1. Think carefully and do let me know. I'm asking you a simple mathematical question to begin with. So I said I already had a 20% stake, 1 PHI. Then I acquired another 50% purchase consideration paid, that is 2, and there is a 30% NCI. So if you add the three elements, the purchase consideration plus the PHI plus the NCI, is that equal to 100%? And you rightly agreed, yes. Let me go back. Now, if you notice in this particular case, what I have done, I have taken the sum total of the purchase consideration and the NCI and the PHI. So in the given example, we can say the purchase consideration is for 50%, the NCI is for 30% and the PHI is for 20%. This means this sum total represents what is paid for 100%. Now, the second question. So when you added the three elements, you got the amount which is paid for 100%. Is this the amount paid for the assets or net assets? The next question is very simple and evaluate. Is this what you paid for the net assets? A got a control over the business of B. That means it was an acquisition of group of assets with without liability. So this 100% what you paid is paid for the net assets or is it paid for the liability? I think you can decide that this 100% is paid, can I say, for the net assets? Because when you acquire a business which is a group of assets with or without liability, so the consideration which you're paying is for the business which is for the net assets of the business. Great. Now, when you say that I'm going to add the liabilities to this, when you say that you're going to add the liabilities to this, now the next question goes to you. When you add the liabilities to this, are you converting the amount which is paid for the assets by adding the amount of the liability? Because this is what is paid for the net assets. And when you add the liability, indirectly, does this mean that this is what you're going to pay for the assets of the company? I think on a mathematical front, you would definitely agree that this is what I paid for the assets of the company. How much do you think you'll pay for a cash? Can I say if you acquire cash, you will pay an equal amount for the cash itself? You could pay more for a building, you could pay more for a machinery, you could pay a fair value more than the book value. But can I say, as far as cash is concerned, if you acquire a cash, you will always pay equal to the book value of the cash. So let us calculate. When you reduce the amount of cash, we can say this is what is paid for the assets other than cash. You can say this is what is paid for the assets other than cash. I would say this is paid for all the assets excluding the cash. So it's a very sequential thought process, a very mathematical input. When you're considering the purchase consideration plus NCI plus PHI, you get what is paid for 100% of the net assets. And when you add the liabilities, you get what is paid for the assets in total. And when you reduce the amount of cash, you come to know that this is what is paid for all the assets other than cash. I guess I am pretty much clear on this. Okay, now let's go back and let's have a look at the example once again. So we can see that in this case, we are going to add 20 plus 50 plus another 30. Now let's take it further. The further information which is given is the fair value of the assets acquired and the liability assumed is given. You're given a building, you're given a cash, you're given a financial liability and a deferred tax liability. Now, a deferred tax liability, you would already know as per Ind AS 12, is completely a notional liability. It is not supposed to be an actual liability. It is completely a notional liability. A DTA or a DTL is completely notional in nature. All the assets and liability in the balance sheet are actual except the deferred tax asset and liability. So I would say this is supposed to be a notional liability, and we can say the financial liability is supposed to be an actual liability. Then he says the fair value of B is 400 crores and the fair value of the NCI is 30% of 400 crores. The business was valued at 400 crores and 30% of that belongs to the outsiders, the NCI, that is 120 crores. And the fair value of the PHI is 80 crores, that is 20% of 400 crores. Now let's do one thing. Let us apply our three-step model. Let's begin with the step number one. Can I say in terms of step number one, I need to add PC plus the PHI plus I need to consider the NCI, and I want to see what is paid for the total net assets. Add the three elements. Now we are given, it says A subsequently acquired a 50% share by paying 300 crores. So what you pay for that 50% purchase consideration is 300 crores. One. Then the NCI is 120 crores. That is two. And 80 crores is the PHI. So you're considering the fair value of the previous investment. You're considering the fair value of the NCI and the consideration. Let's add this. 300 plus 120 plus 80, that makes it a total of 500 crores. So we can, on a mathematical front, very clearly say that 500 crores is what you paid for the 100% net assets. Mind the words carefully. So we can say that in this particular case, 500 crores is what you paid for the net assets in total, 100% of the net assets. Okay. Then let's do one thing. Let's add the liability. But when I am going to add the liability, I'm only going to add what I pay for the actual liability, not the notional liability. So the liability is worth 800 crores, which is actual liability. We're not going to add any notional liability in this case. So we are going to add only the amount of actual liability, which is 800 crores, and that works out at 1300 crores. This is paid for all the assets. This is paid for all the assets in total. But I want to exclude, because if I pay cash as a consideration for the cash I acquired, I pay equal amount of cash. Let's exclude that. So we're also given that the cash is to the extent of 200 crores. So let's reduce 200 crores, and this works out at 1100 crores. This is what is paid for the net assets other than cash. Mind the words carefully. So when you added the three items, PC, PHI, NCI, it gives you what you paid for 100% net assets. Then you add the actual liabilities, you get what is paid for the assets. You reduce the quantum of cash, so you come to know that this is what is paid for the net assets for all the assets other than cash. 1100 crores is what is paid for all the assets acquired, excluding the cash balance. Step one done. Now, as I said in step number 2, you need to now identify a single asset or a group of similar assets. Which asset do we need to identify? I need to see that you paid 1300 crores for the assets other than cash. Which is that particular asset in which the consideration is concentrated? Mind the words carefully again. What I'm saying, you need to consider in this particular case, which is that one asset, or which is that group of asset in which the purchase consideration is concentrated. Now, it's time to look at all the other assets. It is time to look at all the other assets except cash. So which is that single asset for which a maximum amount of consideration is paid? So we can see in my example, the building is that single asset which is worth 1000 crores. So you paid 1300 crores, and you can say for the 1300 crores, you paid a maximum amount for that building, which is 1000 crore. Now, what do you need to do in terms of the step number 3? In terms of the step number 3, you need to consider this building, which is 1000 crores divided by step number 1, 1100 crores. It comes to 1000 divided by 1100, it comes to 91%. It comes to 91%. What does this mathematically mean? 95% of the consideration is concentrated in the building. I put it again. When you calculate the value of the building as a percentage of the total consideration paid for the assets other than cash, you realize that whatever you paid for the assets, 91% of that amount is paid for the building. So if the company is paying a substantial amount of consideration only for a single asset, you're paying an amount and 91% of that amount is paid for a building. That means this is a case, it's not a business. Because if your consideration paid is concentrated only on a single asset, In this particular case, we can say that you are saying that everything is paid practically for a building. If everything is paid practically for a building, then it's not considered as a business. Because if you go to acquire a business with a group of assets, you should have paid a consideration which is supposed to be for a lot of assets. Here, what you paid is almost concentrated in terms of what you're paying for a building. So it cannot be a business. And therefore, the conclusion becomes that it is not a business. I know now questions coming to your mind is, so what should be the correct percentage for this? When you go to conclude that the percentage is beyond which percentage, I would say that it's not a business. Well, the standard does not give you any kind of guidance. It only says that this percentage is something which is substantial in nature. It does not define what is substantial, but generally we can say that if it is almost like more than 90 or more than 90% plus, we would say that it is substantial in nature. But nowhere it is given anywhere in the standard that what is this cutoff percentage going to be. It only uses the word substantial in nature. I hope, friends, I am pretty clear with my understanding on this. Correct? Let us now consolidate the learning on the concentration test. In between, I'll put across questions. If you can answer, good enough. Okay. So let's do one thing. Let me just come back to the position. Rather, I think let's make some quick notes to you at this stage, and I'll keep putting some questions back to you. So my mind is now clearly working on the agenda. When I am looking at, okay, I think Kriti, you said 1100 is the amount paid for assets other than cash. Exactly. Absolutely. So I think let's do one thing. Let's, I think, consolidate the picture in terms of the concentration test. So let's get this clear in terms of the concentration test. So I think in between, I'll keep asking questions and you will get the entire logic as well. Let's summarize the concept here. So we are saying that this has got a step number one. The step number one is calculating the gross fair value of assets. Mind you, the word is gross. So what are you paying for the total assets? In simple words, if somebody were to ask me that what do you technically mean by gross fair value of the assets, I would say, what are we paying? What are we paying? So we are simply saying, what are we paying for total assets? What are we paying for 100% assets? If I were to acquire 100% of the assets, then indirectly I'm putting across a question to myself that what are we paying in terms of the total assets? So when you consider, so in this case, when you consider the purchase consideration plus the PHI, that is called previously held interest. So you add the PHI, that is previously held interest, and you add the NCI, that is non-controlling interest. That is non-controlling interest. So you add up the sum total of the purchase consideration and the PHI and the NCI. So in our example, the PC is paid for 50%, the PHI is for 20%, the NCI is for 30%, that percentage becomes 100%. So this is like the part number A. I'm dividing the step number one into 3 sub-steps to make it very clear. So in terms of the step number 1A, you calculate what is paid for 100% of the assets. Then you go to the part number B. Now what do you do to the answer in A? You add the liabilities. So you're going to add only the actual liabilities and not the notional liabilities. And the only notional liability which appears is a deferred tax liability. So what are you going to do to the figure in A? You're going to add the amount of liabilities. When you do so, when you do so indirectly, what you are doing at this stage, can I say you are calculating what are we paying? What are we paying? This is, to put it simply, what are we paying for 100% of this was net assets, mind you. So this is what we are paying for 100% net assets, and this is what we are paying for 100% assets. So you can see in a chronological sequence, the conversion, what you pay for the net assets, what do you pay for the assets in total? And then you go to the step number C. And to the value in B, you are going to reduce the cash and cash equivalents. And to the value what you compute in B. So after adding the liability, whatever value you get, you reduce the cash and cash equivalents. And by doing so, what are you doing? You're calculating what are we paying? What are we paying? So we are calculating what are we paying for, you can say, assets other than cash and cash equivalents. This is to make you very clear on the agenda. So you can see the stage in which the adjustments is being done. We are first getting 100%, then 100% for the assets, then 100% for the assets other than cash. So this is the crucial step number one. I hope I am very clear on the logic in terms of the step number one. What is the concept of a gross fair value of assets? It is indirectly calculating what do you pay for all the assets of the company other than a cash. Then we go to the step number two. And in terms of the step number two, you need to identify a single or maybe a group of similar assets. You need to identify a single or maybe a group of similar assets. Which assets are you going to identify in step number two? Where the PC is concentrated. So basically, highest asset value. In simple words, what you need to identify, the asset with highest fair value. In simple words, you need to identify the assets with the highest fair value. So you need to calculate which is the asset which has got the maximum fair value in the acquisition. In my example, it was the case of a building. The building was that particular asset which has got the highest fair value. Identify that single or a similar group of assets. In this example, there was no similar assets. There was only one asset which is building. And then finally, you go to the step number three and you consider the value as per, or we can put it as the fair value as per step number two, whatever is the fair value of the building divided by the value as per step one. You calculate the value as per step number one and consider a percentage. And this percentage which you're going to get, if it is substantial, the standard does not define what is substantial, but it has to be substantial. So the moment you say it is substantial, if you say it is substantial, then we can conclude it is not a business. So what is substantial is nowhere been defined in the standard, but generally we presume that if you get a percentage more than 90%, that means the building value is more than 90% of the total consideration which you computed in step one, we can say that. So in this example, it was 1,000 crores as a percentage of 1,100 crores. This was coming to 91%. So this will definitely be considered that it is substantial and therefore it is not a business. Okay. So I guess now the logic would have been fairly clear indeed. I guess you must be absolutely clear with the logic as well, friends. Okay, I think I'm getting some questions. Let me answer that. In the meantime, you can just copy, then we'll take it further. Okay, Shruti, you said, so it is a kind of extended version of guidance only we can say a negative test in terms of if you pass, it'll not be a business. Well, let me tell you, the International Accounting Standard Board, and I'll just go aside. The International Accounting Standard Board, decided that applying the IPO test, what we call a three-element test, can be, very technical for companies to do. So they needed some kind of, or you can say a litmus test, which could give you the results on a very easy manner. Some kind of a test which you apply and you're able to get the conclusions on a very fast basis. So they didn't want to force the companies to apply this particular test, but at the same time, they wanted to ease out the identification when it is a business. So they decided a very mathematical exercise. So they decided that let's give a very convenience kind of accounting to companies if they choose so. Because if the company doesn't want to apply this test, I'm not forcing them, but this would be, easy for companies which might be acquiring certain, multiple assets, and they know very well that they're paying practically for a single asset, though they're acquiring multiple assets together. So for them, it'll be a very easy exercise. So it'll be a call of the company to decide whether they want to apply this litmus test and get the results fast or not. Because every time you tell a person to apply a comprehensive test like an IPO test, it can be very time consuming and expensive at the same time. Because you will need experts to do the calculations and all and make an assessment on the judgmental facts. So which can be very time consuming and an expensive exercise. So considering that, these standards are based on the fact that the cost involved in making assessment should never be large. Because we always want that the companies do not spend a huge amount of money in terms of making an assessment. They wanted to ease out the situation, and therefore an optional litmus kind of a test was given. That's called a concentration test, right? And sorry, here another question. So why notional liability is not added? Well, deferred tax asset or liability is purely a difference arising due to a gap between accounting and taxable income. So it is not something, which is actual in nature. So when you're calculating what you pay for a business, you're going to pay for the actual assets. You're going to pay for, what you have to assume as actual liability. I am not going to make any changes in the consideration on account of any notional assets and liability. So therefore, they decided that the consideration a company pays is for the real assets and real liabilities and not notional. So therefore, they decided that you're not going to pay in terms of what is notional, right? Okay, I think Jyoti, you've got a question. So what if we get a different conclusions from the concentration test and a IPO test, then what would we prefer? I guess we just forgot that. I, at the very inception, gave you an input. I think let me just remind you back. I had given you some inputs at this very stage itself, which you need to keep in mind. And this is a concentration test has got certain permutation combinations. You may choose not to apply, then IPO is mandatory. Or you may choose to apply, and if you pass, it's not a business. But if you fail, you have to again apply an IPO test. So the situation is, I am asked, do you want to apply IPO? Do you want to apply concentration? I said no. Then IPO mandatory. I said, do you want to apply a concentration test? I did, and I passed the test. I've concluded nothing to be done further. It's not a business. I applied the concentration test, I fail, I am now supposed to do the IPO test, and whatever IPO test decides is the final answer, right? I guess I'm pretty clear on the permutation combinations, right? Okay, so far so good. I guess everybody is now clear with the idea. So I have given you the concentration test. Now it's time to give you the next one, and that is IPO. Okay, in between, first, let me ask you, friends, are we absolutely crystal clear with the application of the concentration test? The logics are clear. You know now how the concentration test is being applied. And of course, the permutation combinations that if it passes or fails, or if you don't choose to apply, what is to be done? Correct? Okay, Shruti said, so along with the building, if land was there, then 900 fair value and then 1900. Don't worry. If you're looking at multiple assets, we'll come to that very soon with more examples coming on IPO test. The moment you change the example, the answers could vary a lot. So let's concentrate only on the given example so far. Okay. Right. It's absolutely clear. Wonderful indeed. No doubts. And Salish, you said, sir, when it should be said that a concentration test fails. Well, when the concentration percentage is generally below 90, but as I said, that 90 is not a cutoff percentage. The standard only says that if your percentage is substantial, you pass. If it is not substantial, you fail. What is substantial is nowhere been defined, and judgment in terms of examinations are never evaluated. So if you're thinking, sir, please give me a cutoff factor, generally, if you're going to get a question in the exam, I assume fairly it will be 90% plus, because judgment is not tested in exams. We're pretty safe. Okay, crystal clear, wonderful indeed. Okay, I think Abhijit, you said, so what do you mean by net assets? Net assets means assets minus liability. When you acquire a business, what do you pay for? Assets or assets minus liability? You pay for assets minus liability. And what is that? Net assets. Correct? Okay. Now, friends, a little complicated discussion, and let's now go to the next area of discussion with you, and that is discussing the element in terms of IPO. I don't know if I have been speaking much technical things, though the electricity board had a different view. They took my electricity away, stating that, indirectly I've been saying a lot of technical things since morning. But trust me, I am going to do a little more technical discussions now at this stage. I hope the electricity authority doesn't take away my electricity at my discussions now. Okay, now hear me very carefully in terms of the next, that is IPO test. There is a very interesting chart which is given in the study material, and I want you to have a look at this chart. It's a very beautiful chart. I think it's a very good work done. And the chart is very interesting and illustrates the concept of what we call a IPO test. Now, friends, I'm going to convert this into a three-step model. After the chart is explained, I'm going to convert this into a three-step model. So you don't need to write anything at this stage, but just hear me very carefully, and then I'll convert this into a three-step model. I'll do a few examples also. I am carrying a few examples issued by the International Accounting Standard Board. When they introduced this definition of business based on an IPO test, they gave certain illustrative examples. I'm going to take those examples also with you to give you clarity. Though in the exams, we have never been asked in the exams to evaluate this IPO test or the concentration test. But you never know, it could be the first time. So we'll not take chances. Now, hear me very carefully at this stage. Number one, in order to say that a group of assets with without liability is a business, there are three elements which the standard setters say need to be present. Don't write anything. I'll give you the notes very soon after the chart is understood. So the standard setters very clearly say that there are a total of three elements before you conclude that a business, a group of assets is a business or not. One is called input, one is called a process, and the other one is called an output. So there are three elements. One is what we call input, one is called a process, and one is called an output. And I call this as IPO. That's where I get my name, and that is what I called IPO, input, process, output. Now the question arises, what is an input, what is a process, and what is an output? Let's take a very simple example to understand this bit. Let us say I am a car manufacturer. Now, if I am a car manufacturer, what is the input for me? You can say is the steel sheets. And what is the output for me is supposed to be a car. I am using the input in the form of steel sheets, and my output is in the form of a car. But there is a certain process which is required to convert this input into output. Please mind the words very carefully. So as an entity, if my business is to manufacture a car, you've got certain inputs, that is steel sheets, and you've got output, there is a car, and there is a certain process which converts that input into output. Similarly, for example, if you look at companies, which are manufacturing Coke and Pepsi, so you can say they've got an input which is like water, and they're converting that into an output which is Coke and Pepsi. So there will be a certain process with which the input is converted into output. The standard setters decided one thing, that for the acquisition of a business, what is most important is a process. The output is there or not, because I might be acquiring somebody's assets and liability, where they may not have an output. They may be a startup entity and they may not even have an output. When I say output, it generally means that there is a presence of revenue. So in order to see whether a company has got an output or not, you need to see basically that is there a presence of revenue. If the company is already earning a revenue, there is an output. And if the company is a startup company and there is no revenue, I would say there is no output. The standard setters decided the presence of output is not important, but the presence of input and a process is very important. So the chain starts something like this. It says, did you acquire input and process? You can see the word output is not there. So I would say that you need to first of all ask yourself a question. Did you acquire the input and process? If you say no, it cannot be a business, then it is asset. The chart very clearly says that if you say the answer is a no, then you go to A. A means we are saying that it is supposed to be an asset acquisition. And when I say B, B means it is a business combination. 103 would apply. So your very first step is to ask yourself a question, did we acquire input and process? Now let me also clarify one more thing at this stage. When I say a process would also mean an organized workforce. A process would also mean, some kind of employees who have got the necessary technical knowledge in terms of converting the input into output. The administrative staff of the company, the payroll employees of the company, they are not supposed to be organized workforce. When you're looking at organized workforce, it means the people who've got the necessary skills and the experience. The employee is an input as well as a process. Mind the words carefully. The employee of the company is not only an input, but he's also a process of the company. But every employee of the company is not a process. When you're looking at the concept of a process, the people who've got the technical knowledge and expertise in the field in which I am doing a business, I would say they are the organized workforce. They're not only an input, but they're process as well. So even if I may not take over a technical formula to convert water into Pepsi, it's okay. But I take over those organized workforce, the people who know the knowledge of converting that water into Pepsi. So when you say organized workforce, they will also be considered to be a process as well. So the very first question you're going to put across to yourself is, did I acquire input and a process? If no, asset acquisition done. If yes, then you go further. So if you say a yes, then you go further. So this is like step number one. This is like step number one, where you need to identify, did you acquire the input and process? Don't worry, we'll do case studies also, but first let's understand the concept. Next. Then you go to the step number two, whether output is present on the acquisition date or not. It's going to be very simple. In a case study, how would you evaluate whether output is present or not? If there is a revenue, there is an output. If there is no revenue, there is no output. So you need to look into the case study and see, is the acquiring company, is that entity earning a revenue or not? So the presence of revenue means output is there, and the absence of revenue means there is no output. So in step number two, you'll just identify the output is there, yes, the output is not there, no. Just identify and see, is the revenue present? Yes, output is there. Revenue is not there, output is not there. Then you go to the step number 3. Now, this is my entire step number 3. This is my entire step number 3. Now, let me tell you something for ease of convenience and ease of remembrance as well. If a business has got output, there is revenue, I will be less stringent in deciding whether it's a business or not. And if the business has got no revenue, there is no output, I will be less stringent in deciding things. I'm putting it point blank. The moment you say that in this particular case, the moment you say that output is present, I'm going to be less stringent in deciding things. But if you say that the output is present, then I would be less stringent. If there is no output, I'm going to be more stringent in terms of deciding things. Now, if you say, yes, there is an output, let me read. Whether the process is critical to the ability to continue and the inputs acquired include an organized workforce. There are two conditions. There are two conditions. So there are two conditions in this particular case when I'm looking at this parameter. And what is the condition I'm looking at? You need to put across a question number 1. Is the process critical? And number 2, did you also acquire an organized workforce? You need to look into two parameters. Number 1, the process needs to be critical. So how would we decide that the process is critical? Well, you may not get case studies which are technical, but looking at the language of the question, we will be able to decide, is it critical or not? So you need to decide that it is something critical. Without this process, I cannot do anything. It is critical. So the process is critical and an organized workforce is acquired. If you say yes, it is undoubtedly a business. You meet the two conditions, it's a business. You don't meet the two conditions, don't get worried. We will check other way around. So even if you say a no, no worry, then you will ask another question, whether the acquired process is unique or scarce, or it cannot be replaced without significant cost. Then you need to put across a question, is the process something unique or scarce? Is this something, or is this process something which you cannot replace? Because if I don't take this process, I can't even function. The process is unique or something scarce, or the process is something which I cannot replace. So if you say a yes, then it is a business. And if you say a no, it is an asset acquisition. So which means the moment you say that there is an output on the date of acquisition, the revenue is present on the date of acquisition, you got to put across two questions to yourself. Is the process critical? 1. Did you also acquire an organized workforce? 2. You say a yes, business. You say a no, don't get worried. You put another question and ask yourself, okay, tell me, is the process something unique or scarce? Or you can tell me that you cannot replace this process. If the process is unique or scarce, or it cannot be replaced, it is a business. Otherwise, it is an asset acquisition. Don't worry, we'll document that. Now coming to the next part, we said no. Then you need to see whether the process is critical. That is 1. If you say yes, you put another questions, whether the input acquired includes an organized workforce, and the workforce and other inputs have also been acquired. So if there is no output, there is no revenue, you need to put across 3 questions. Number 1, the process is critical. Number 2, you acquired organized workforce. And number 3, you also acquired other inputs. Other inputs in the form of raw material. So other inputs would mean, for example, raw material, building, machinery, they're all supposed to be inputs. So if there is no revenue on the date of acquisition, you need to put across 3 questions. The process is critical. You acquired an organized workforce. And you also need to put across a 3rd question, that in this case, you acquired other inputs as well. If you say yes, it's a business. And if you say no, it is an asset acquisition. Sir, this is getting heavy. No worry, we'll take examples to illustrate the logic as well. But I think let's first of all concentrate on a three-step model. Let me first document this to you, and then we'll apply the case studies, and you'll get a clarity in terms of how the three-step is applied. So I'm going to convert this into a three-step model. So let's do one thing. Let's convert this into a three-step model. You can start loading it down. So let me just convert this into a three-step model. This is what I call the IPO test. So this is what we call an IPO test, which is mandatory. And you know this is applied when you don't apply concentration, or this is applied when you fail a concentration test, then it is applied. Okay. So let's convert this into a three-step model. You can start noting it down, and then we'll do some case studies where we'll see the concentration test application along with the concept of the business IPO test as well. Step number one. Did we acquire both? Circle the word both. Input and process. Underline input and process. So acquisition of process is important. So you're going to first ask yourself a question: did we acquire input and process? Now the answer would be either a yes or a no. So the answer would be either a yes or the answer would be a no. If you say no, we did not acquire both input and process, just inputs, in this particular case, it is not a business. When I say it is not a business, it implies it is asset acquisition. It implies that it is an asset acquisition. The moment I say it is not a business, it is an asset acquisition. If you say a yes, go to the step number two. So the first thing to be seen in the question is, did we acquire input and process? Output is not relevant. So let me put it out here so that later it doesn't disturb you. So we are not looking at the presence of the output in step number one. In step number one, you don't need to see the output, only the input and the presence of process is to be seen. Then you go to the step number two, in which you decide, is the output present? Is the output present? Underline the word output. So is the output present? Output would be in the form of revenue. Output will be in the form of revenue. Is the acquiree already earning a revenue? So is the acquiree already earning a revenue? Then I would say yes, output is there. Not earning a revenue, output is not there. So here again, the answer would be a yes or a no. Just identify that, that's it. So you just need to identify whether the output is there or not. Irrespective, you go to the step number three. Irrespective, you go to the step number three. So step two is pretty easy. You don't need to identify anything in terms of things. So in this particular case, you can easily just have a look at the fact and see that output is there or output is not there. Simple and straight indeed. Okay. Then we go to the step number three. Then we go to the step number three. Now, in terms of the step number three, what I need to do now, I am going to be very careful and let's make a chart. You've already seen that the output is there or not, so we're going to accordingly decide. So we say that output is there. I say output is there, or I say output is not there. Output is there, or I say the output is not there. The presence of revenue is there, or the presence of revenue is not there. Remember, if there is output, I am going to be less stringent. And if the output is not there, I'm going to be more stringent. I'm going to be more strict. So if the output is there, I'll be less stringent, less strict in terms of evaluating. So you'll see easier conditions. And if there is no output, I'm going to be more stringent. That's how you can remember. Now, if the output is there, you need to meet you need to meet 1 plus 2, or you need to meet this condition. Remember, if the output is present, you need to meet two conditions, this plus this. One is the process is critical. I'm just giving you the crucial words. The process is critical, underline critical. The standard does not tell you what is critical. We'll see the language of the question to decide, is it critical or not? And number two, organized workforce, organized workforce, organized workforce is taken. You've also taken over the organized workforce, the people with the necessary knowledge and expertise. The people with the knowledge and expertise, they would have also been taken. That is one. You meet both of them. So when I say plus, you need to meet both of them. Or you need to prove it to me that the process is unique. The process is unique or scarce. The process is unique or scarce, or the process cannot be replaced. The process cannot be replaced. So in this particular case, you prove me either of the two. So either prove these two or prove this one. So either prove these two or prove this one. Either prove it to me the process is critical and you've taken organized workforce, or prove it to me that the process is unique or scarce or you cannot replace it. And in this particular case, we need to meet three conditions. You need to meet a total of three conditions. You need to meet all these three conditions if there is no output. And one is, this is same. You can say same as left-hand side. It is same as the left-hand side. The process is critical, organized workforce is taken, is same. And other inputs have been taken. Other inputs have been taken. So you need to also prove it to me that other inputs have also been taken in this case. So that is the crux in terms of a three-step model. Now I will do some case studies to make it very clear to you, but I think this is the crucial step that you need to consider, that the output is there, prove the two or one, and if the output is not there, prove all the three. Process is critical, organized workforce taken, other inputs taken. If you say yes to all of them, then it's a business. So if you pass this, it is business, and if you fail. So if you pass these tests, it is business. If you fail these tests, it is asset. Same goes out here. If you pass these tests, it is business. And if you fail them, then it is supposed to be asset. Okay, so I think we are ready to do some case studies with you. I guess if there is any question, let me see if any questions coming in. Okay, I think Shruti has got a question. So one basic logic question is, why is the third step after the second step? I mean, the third step relates to the process only, then why after the output or the revenue is being taken? Okay. Well, in the step number one, we never looked at the presence of output. If you ask me, step number 2 and 3 can be merged. If you ask me technically, I think I would have taken a liberty of, making 3 steps, zabardasti, because I'm fond of making 3 steps. So if you technically ask me, you could merge the 2 steps, second and the third one. In the first, you just look at the input and process. And then in the second step, you look at the output is there or not, and accordingly do this. So technically, if you ask me, step 2 is not required. So you could condense this into a 2-step model as well. I agree with that, right? It is just, since my baby stuff, I intentionally wanted to convert it into a 3-step model. That's all what I would say. Okay, right? Okay, so let's begin the journey, friends. Now I am going to do some case studies with you, just maybe 2 or 3, so that we get a complete insight of things. Okay, so I'm just added some case studies with you. And I think let me just take you to those case studies to give you a little more clarity of thought. Okay, so let's have a look at a case study. These are certain case studies which I've taken from International Accounting Standard Board. See, friends, is that visible enough? Good to see. Otherwise, I'll zoom it further. Just see if this is visible, good enough to see. Then I can take it further. Okay, so we're going to read each and every case study. I think I might have to zoom it a bit, maybe. Okay, I think let me zoom it a bit. So we can just zoom this a bit. I think let's look at the example number 1 and the example number 2. Okay, I think that's good. Should be visibly quite clear. Okay. So let me begin the journey. I'm going to ask a few questions. If you can answer that now, please concentrate very carefully, because I'm going to apply the concentration test. I'm going to apply the IPO test if the concentration test fails. And we're going to decide whether it's a business or not. This will just give you a clarity in terms of both the kind of test. Okay, let's have a look now. It says an entity S sells its radio broadcasting assets to another entity, assets, group of assets. I need to decide, is it a business or not, with the help of concentration test if I choose to apply. The acquired set of activities and assets are comprising of a broadcasting license, a broadcasting equipment, and a broadcasting studio. You need to be careful that there are 3 assets which are all related to broadcasting. One is, you can see, is a license, an equipment, and a studio. You need to see if there is any interconnectivity between the 3. Well, I think a license is capable of independent use. An equipment is capable of independent use. A studio is also capable of independent use. So you cannot say that they are similar in nature. You cannot say they're similar in nature, because this is a license which is intangible. The equipment and studio is something which is tangible, but they're not something which are not capable of independent use. You can acquire a license and take equipment from somebody else. You can take an equipment and you can take a studio from somebody else. So you cannot say that they are considered to be similar assets. So grouping of these assets cannot be done. Now, let's go further. Just hear the words very carefully, what I'm saying. At the acquisition date, the fair value of each asset is considered similar. I have a question, friends, to you. Let's see, how do you react? He says on the acquisition date, the fair value of each asset is considered similar. Can I say, if you consider the fair value of any asset as a percentage of the gross fair value, it'll be not substantial. Agreed? If the fair value is equal, the consideration is not concentrated in any particular asset. Make your analysis and vouch me. If you're looking at the fact that the fair value of each of the asset is considered similar, that means every asset has got a value, let's say 1/3, 1/3, 1/3. Everything has got a value x, x, x. So every asset is 1/3 of the total consideration. And that's rightly said. So the concentration test is undoubtedly going to fail. So this is clearly telling me that the concentration test will definitely fail. If the concentration test will fail, the IPO test becomes mandatory. The moment the concentration test will fail, the IPO test will become mandatory. Now it says no processes needed to broadcast the radio shows are sold, and there are no employees or other assets or activities included. Entity S has stopped using the acquired set of activities and assets before the date they are sold to the entity R. The acquiring company, the seller company, has stopped using these assets, which means it has got no revenue. If it has got no revenue, it means it has got no output. Identify if the transaction is an asset acquisition or a business acquisition in case the entity decides to apply the optional concentration test. I think now, since the concentration test has undergone a failure, we need to apply the IPO test, and I need to apply the IPO test using a simple three-step model. And I think you would have already decided your answer, but let me still ask you. He very clearly says that no processes have been taken over and no employees have been taken over. So if I ask myself the very first question, did you acquire the input and process? I think I would definitely say a no. There is no need to look at the step number 2 and 3 as well. Because at the very first instance, when the question clearly tells me that no processes have been taken over and no employees, which means you did not even take over the organized workforce, which could be considered as a process. And if you have not taken over the organized workforce, which could be considered as a process, we have not taken over the process. So what is the conclusion? That it is supposed to be an asset acquisition, right? I guess you would have understood the analysis. If you have understood this example, you've understood a simple application of the IPO and the concentration test. The earlier concentration test question which we did was based on a mathematical data. And this one was fairly simple because with the presence of the input that the fair value is almost similar, you could easily give a conclusion as well. Okay, then that's right. He said this is definitely an asset acquisition. Wow, great. Let's, I think, try another example, friends, with you. Let's try another example with you. This time you try it out. It says an entity A purchases another legal entity, and which is a solar cell. Entity solar cell carries out research and development activities on several solar projects that it is involved in, and they are currently in progress. So they've got a lot of solar projects they are involved in. I know I'm applying a concentration test, but before that, do you think there is output? Do you think there is a revenue? Yes. It very clearly says that they are currently in progress. It has got scientists who possess the skill, knowledge, and the experience needed to perform these activities. So you've got those scientists, and the scientist is supposed to be considered as an organized workforce because they've got the knowledge and the expertise. It has also got tangible assets which include equipment, factory, laboratory to perform such activity. Currently, the product is not ready to be marketed. Sorry, I misinterpreted that. It now clearly says, and no sales have been made. So the projects are in progress, but he says, I've not made any sales so far, so I've got no revenue, so which means there is no output. Then he says, all the assets acquired are deemed to individually have a similar fair value. Wow. He's again very clearly telling me that all the assets acquired are deemed individually to have a same fair value. I think I can ask you, what do you think is the fate of the concentration test? If the individual assets have a similar kind of a fair value, we can definitely say that the concentration test will fail. And if the concentration test will fail, then I am supposed to, on a mandatory basis, apply an IPO test as well. And Shruti, Sir Claire, you really explained well. Thank you so much. Okay, so in this particular case, the CT test will fail and the IPO test becomes mandatory. So now let's apply the three-step model which I gave you in order to decide whether it's a business or not. Now, in step number 1, we need to consider, did we acquire the input and process? I think we have very clearly given the inputs in the question. It has got scientists who possess the skill and knowledge and experience, and you've taken over tangible assets like equipment, factory, and laboratory. So inputs have been taken, processes have been taken. The organized workforce is both an input and a process. So we can say, yes, input and process have been taken. Then I go to the next step and I say that is there an output which is present? No. There have been no revenue. There have been no sales. So in this particular case, the output is not present. So if the output is not present, we've got a more stringent test, and we need to consider the three elements in this case. Number one, is the process critical? You are into research and development. And the research and development is involving certain scientists. So I think without these scientists, you will not be able to conduct any further research and development. So is the process going to be critical in nature? I would say yes. And then I say, did you acquire the organized workforce as well? Yes, the scientist or the organized workforce, the processes are critical, the organized workforce is acquired. And did you acquire the other inputs as well? Yes, I acquired an equipment, a factory, a laboratory. These are the other inputs which are acquired as well. So all the three elements are present. It is critical, it is organized workforce, and other inputs have been taken. So what is the conclusion? That it is definitely a business. So I think if you can understand these examples, these are examples given by the International Accounting Standard Board, I think we are well sorted in terms of things. Okay, Shruti, you said, sir, how will we get to know if the process is critical or not? Okay, now in this case, it says entity is doing a research and development activities on several solar projects, and you've got scientists who get the necessary skill, knowledge, and experience. Now, company is into research and development, which needs expert people, not ordinary people, but scientists who have the requisite knowledge and experience. So I think the organized workforce, which we're calling it as a process itself, is something very critical in nature. Without these particular people in hand, we may not be able to, conduct the research and development. So I think the criticality arises. So we will be able to prove that yes, it is critical, and they are the organized workforce as well. And of course, other inputs have been taken as well. Right? Okay, and I think we got the answer, business acquisition. That is right. Okay, wonderful indeed. That is superb. I guess you have got your comfort zones as well. Now, before we go further, friends, I have given you an introduction to the subject of business combination index 103. I know it's too early, but I am sometimes in a good or a bad habit of asking people to do a self-assessment as well. That also gives me an insight in terms of your understanding of the subject. I need to maneuver my, things accordingly. So I want you to do something at this stage. Do a self-assessment of your understanding and tell me whatever we've learned so far, what is your comfort zone if you were to scale yourself on 1 to 10? If you want to scale your understanding, don't scale my way of teaching. You need to scale your understanding in terms of a scale of 1 to 10. What has been your understanding on this? Now, before you do that, I'm just going to first of all quickly do some quick revisions to you before I take it further to the next stage. Then you're going to give yourself a score. So in the meantime, decide your comfort zones, and then I will take it further. Okay, I think Shruti, you've got a question. But you said, can we say that if it is organized workforce, so process will always be critical? You can say that. You can say that if you're acquiring an organized workforce, I think typically you can say it is critical. I agree. Okay. Now, before you give yourself a comfort zone scores, friends, I am just going to go do a little mind mapping before I take it further. So what I'm going to do at this particular stage, I am just going to do a quick mind mapping of things with you before we take it further. So please watch this carefully. Next 5 minutes, just relax your minds. You're going to hear me very well. And please do revise all this bit as well, because I'm just going to start the introduction to the accounting treatment as well after my quick mind mapping is done. Today, we learn something very important. I just want to create a mind map, and I would always advise that you should create these kind of mind maps for every standard, every subject as well, because it does a very good thing, before the exams. It gives you a quick idea of all the concepts at one place. Now, I started my journey on a 3-step model. I started my journey today on a three-step model in terms of Index 103, where I gave you in terms of three-step model that when does Index 103 trigger? We decided that one does Index 103 trigger, and we decided a simple three focus points. I'm not giving you the steps in detail, just to remind you the basic input. In terms of the step number one, we decided, did you acquire an individual asset or did you acquire a group of assets? The first focus point is to decide that did you acquire an individual. One thing was very clear, that if you acquire an individual asset, tangible, intangible, this standard cannot become applicable. So what is important is you acquire a group of assets. Then we went on to the step number two, and we decided that is this group of assets supposed to be a business or not? So what is important is that it should be a business before we could conclude that 103 is applicable. And what I did, later on, I gave you the inputs in terms of deciding that it is a business. And we said that there is supposed to be a concentration test and there is supposed to be an IPO test. So later we understood the mapping, that when you're deciding that it is a business or not, you've got two kind of tests. One is the IPO and one is the concentration test. This is optional. This is optional, and this is something which is mandatory. I gave you a clarification as well. And the clarification I gave you, that if you apply a concentration test and you pass, you are decided, it's not a business. If you fail the concentration test, or if you refuse to apply the concentration test, then the IPO test becomes mandatory. Thereafter, what we decided, in the concentration test again, I gave you a three-step model. In the concentration test as well, I gave you a three-step model. And in this particular case, we had step number 1, 2, and 3. This step had three sub-steps, ABC. At the first instance, you need to calculate the sum total of the purchase consideration, the previously held interest, and the PC. And this will give you what is the amount paid for the net assets. This will give you what is the amount paid for 100% net assets. Then you go to the B part and you add the liabilities which are actual in nature. So you convert what you paid for the assets, and then you reduce the cash and the cash equivalents, so that you convert what you paid for the assets other than cash. So it's a chronological order: what you paid for the net assets, what you paid for the assets, and what is paid for the assets other than cash. And then in step number 2, you identify that single or a group of assets which has got the highest fair value. You need to see that which is the asset which has got the highest fair value, and then you express the value in step 2 upon the step number 1. The value as per step number 2 as a percentage of step number 1, and you need to get a percentage which is almost like 90% plus. But this 90% plus is not a defined percentage. It has to be substantial. But for our understanding, we are considering it should be 90% plus. Then we came to the concept of an IPO test. And in terms of the IPO test, again, I gave you a three-step model. You can see the three-step model here, the three-step models here as well. Everything three-step to easily remember. Now, in terms of the IPO test also, what I gave you, that you need to first of all see, did you acquire input and process? A good clarification which I gave you, inputs are like building, machinery, labor, raw material, etc. But that organized workforce is not only an input, but it is a process as well. The only example which is both an input and and a process is supposed to be the organized workforce, the people with the requisite experience and expertise who are going to be called as the organized workforce. If you say a yes, then you look into whether the output is there or not, and the output is nothing but you're looking at the presence of revenue. The revenue is there, output is there, less stringent to decide. The revenue is not there, the output is not there, more stringent to decide. So if you say that there is no output, you need to consider three elements. You need to consider three elements. The process is critical, one. Organized workforce is taken, two. Other inputs have been taken, three. And if you say, yes, there is an output, then I am going to be less stringent. So you need to meet the two conditions or the one condition. That's easy to remember. You need to meet the two conditions or one condition. What is the two conditions? Critical, process critical, organized workforce, or prove it to me that the process is unique, scarce, or it cannot be replaced. So we took up this journey later, though this was connecting to the step number two, the main step, whether it's a business or not. Now, once you decide that yes, it is a business, you go to the focus in terms of step number three. And if you remember, here I also give you a clarification. I also give you an example here. When it was not a business, how do you allocate the consideration in the ratio of relative fair value? Illustration one. I gave you that illustration number one, where you saw the allocation of the consideration in the ratio of relative fair value if it is not a business acquisition. And finally, we came to the step number three to decide whether we are getting a control or not. It is only if you get a control that this standard applies. So what is important is you acquire group of asset one, you go to the second one, it's a business two, and you get a control three, then 103 triggers. The moment you say the control is present, you would apply Ind AS 103. This is applied once. This is applied only once at that time when the acquisition takes place, and every year thereafter, you apply 27 for separate financials and 110 for consolidated financials. So this has been our entire learning of the base theoretical understanding. When does Ind AS 103 trigger? Now you're clear with the concept of business identification and the control assessment. Of course, we'll be dealing later in detail in 110. Now I want you friends to give your comfort zone scores bit before I take it further. Okay, I think Mansha, so please share the link of the International Accounting Standard Body website. Well, if you want to do it for understanding perspective, just Google it out, IFRS Foundation, and you will be able to get that IFRS Foundation. Though you can see these examples are also there on the ICAI website as well. The issue is also, for understanding point of view, given some examples, and you'll see the IFRS accompanying guidance is there on the Accounting Standard Board page as well. Okay, I think Kriti, so your three-step model concept is easy to understand, and remember, it gives the crux of the concept, helps in deep understanding. That's great. Thank you so much, Kriti. Okay, I think the score coming, Mansha is 8, and Manan is 8. And Shruti is 7. That is pretty good enough. Let's get some more scores coming in, friends. I need some more scores coming in. So give me your self-understanding of what we have done so far. I know it's technical. I know it's quite technical indeed. But if you're getting a score of anything like 7, 8, I think it's pretty good to go with. Okay, so far understanding is 9. That's great. And Nathal is 9. Kriti is 9. Yedu is 9. Okay, that's wonderful indeed. Super. Okay, now let's go to the next phase, because we need to make a little background in terms of further discussions as well. We've got some time. Yes, we've got another 10, 12 minutes. So I want to take it further. So let me now take it back. I am now going to create a further inputs to you. Don't worry, nothing too technical, but I think I need to give you a base background so that we can do a deeper discussions on this. Once you've decided that Ind AS 103 is applicable, Once you've decided that Ind AS 103 is applicable, we need to consider the accounting. Now, please hear me very carefully, because what I'm going to give you is going to be the base for our discussions in the future part of Ind AS 103. Well, I would say there are three kind of situations. I would say the accounting will fall in three different situations. I'll put it as situation number one. I'll put it as situation number two. And I'll put it as situation number three. Now watch this very carefully. You're going to get some more good understanding on this particular standard. Because before we get into the nitty-gritties of accounting, I would say there are three kind of situations. So there are going to be three kind of questions you're going to get exposed in the exams on Ind AS 103. Let's take an example to understand this. There is a company A and there is a company B. There is a company A and there is a company B. Now let's go one by one. Let's look at the first case. Let's say company A gets a control, or let's not put it as gets a control. Let's say A acquires the business of B. Let's say A Limited acquires a business of B. Now watch the maths very carefully. The number of shares in the balance sheet of A is, let's say, to the extent of 100. And the number of shares in the balance sheet of B is, let's say, 60. The company A has got 100 equity shares in the balance sheet, and the company B has got 60 shares in the balance sheet. A acquires the business of B and tells the shareholders of B, I will give you 1 share for every 1 share. A Limited tells the shareholders of B that I will give you 1 share for every 1 share in my company. Now, can I say the company A shareholders have got 100 shares, and once they issue another 60 shares to the shareholders of B, what is the percentage stake A shareholders will have in A? Mind it carefully. The shareholders of company A had 100 shares in their company, and they gave another 60 shares to the shareholders of B. And we can say now the shareholders of company A have got 100 shares out of 160 shares in the company. So what is the percentage stake they've got? They've got 100 shares out of 160. It comes to 62.5%. Has A got a control over company B? Yes. A acquired the business of B and gave the shares in such a way that he gets a control over the business of B. So in this particular case, I would say A Limited is the acquirer. I would say A Limited is the acquirer, and what I would do, I would apply in the books of A acquisition accounting. I would apply in the books of A what we call acquisition accounting. So A issued the shares to the shareholders of B in such a way that he gets a control over the business of B. A is the acquirer, and he would do acquisition accounting in the books. I hope I am pretty clear with my first example. Okay, now let's take it further. Now, in this particular case, let's take another example and let's understand this. Let's say A Limited acquires the business of B. Let's say A Limited acquires the business of B. Now let's have a look at acquires a business of B. Now in this particular case, let's consider the same shares, 160 shares. Now A Limited tells the shareholders of B, I will give you 2.5 shares for everyone. Sir, how can we issue 2.5 shares in fraction? Don't get worried on the fraction at the moment. But let's say A tells the shareholders of B that I will give you 2.5 shares for every 1 share in your company. So now we are calculating A has got 100 shares in the company, and they gave how many shares to the shareholders of B? 60 into 2.5. So they land up issuing a total of 150 shares to the shareholders of B. So what is the percentage stake? They are left with 100 divided by 250 it comes to 40%. Wow. Now, A Limited acquired the business of B in such a way that he lost a control. He did not get a control, but he lost a control. He is acquiring the business of B, but at the same time, when it came to the consideration, he lost a control over the business of B. In this case, it is not A, but it is basically B who becomes an acquirer. In this case, it is not A, but it is B who is becoming an acquirer. A gave the consideration in such a way that the control passes to B. Because the shareholders of A are getting a 40% stake, which means the shareholders of B have got a 60% stake in the company. In this particular case, B would apply what is called reverse acquisition accounting. In this case, what we would do, he would apply what is called a reverse acquisition accounting. So you can notice that when a company acquires a business and retains a control, we do acquisition accounting. If a company issues a shares and loses the control, we apply reverse acquisition accounting. When the person giving the consideration loses the control, it is called reverse acquisition. So we need to understand how acquisition accounting is done, how reverse acquisition is done. Now, in both these situations, this is a transaction between unrelated party. This is a transaction between unrelated party. When an unrelated party enter into transactions, when unrelated parties enter into transactions, it can be acquisition accounting, it can be reverse acquisition. The third situation is when the accounting is done between related party. When the accounting is done between a related party. I'll not come to how the related party is done. We'll see that later. But if the transaction is done between a related party, then it is called a common control transaction. Then it is called a common control transactions. So we can say there are going to be three kinds of questions and three kinds of accountings which we need to understand and appreciate. One is, I'll put it like this, one is unrelated party transaction where you retain a control, acquisition accounting. Second is unrelated party transactions where the control is gone, reverse acquisition. And the third is a related party transactions where a common control applies. Now, Index 103 addresses all the three kinds of accounting. If you notice, the standard has got the main text. The main text gives you acquisition accounting. Then there is Appendix B, because Appendix A is containing the definitions. Then there is Appendix B, which explains the reverse acquisition accounting. And then there is Appendix C, which explains the common control transaction. So in order to understand this entire standard, we've got to understand the main part of the standard, which will give you acquisition accounting, how it is done. Then there is Appendix B, which explains the reverse acquisition accounting. And then there is Appendix C, which explains the concept of common control transaction. So once you're able to understand the acquisition accounting, the reverse acquisition accounting, and the common control transactions, Appendix BC, and the main part of the standard, life jingalala, you will be able to understand the entire standard. So I've given you this background because what I will do, I will start in the next class with you the concept of acquisition accounting. I have divided the acquisition accounting again into a step-by-step model where we will be able to see in a very chronological order that what are the complications arising in each step. And we will be able to crack the questions on acquisition accounting. Majority of the question which comes in the exam so far have been on acquisition accounting. There has been a single question which came on reverse acquisition also quite some time back. And there have been a few questions which have come on Appendix C. So far, all the areas have been touched in the exams: acquisition, reverse acquisition, and a common control transactions all. So that becomes a base to the standard, friends. And I think I've created some base. Your ratings were very comfortable indeed. I think most of you have given almost a score of almost like 8 plus and all, 7, 8 plus or 9, which is pretty good. And I think wonderful indeed. But what you need to do, friends, now is you need to please revise this class as well. It won't take you much time on what we have done. And next class, what I will do, that is on Thursday, we're going to start with the concept of acquisition accounting to you. Okay, I think Shruti, you've got a question. So why should A do such a thing which results in losing of control? I'll explain that logic as well. When I'll come to the concept of reverse acquisition, this is a very good technique of converting an unlisted company into a listed company. So why do we do reverse acquisition? What is the shortcut? I will explain all these things when we come to the concept of reverse acquisition. No worries on that. We'll be coming to that also in detail. Okay, friends. So I think if you've got any questions, and Shruti sir, it'll be 8 marks question in the exam. Well, a reverse acquisition could be anything, the questions on business combinations could be anything like 8, 12, 16, anything. It could range to any marks. Thank you, Kriti. Thank you so much indeed. It was pleasure, I think, teaching you all today. So I will be connected because we've got almost like 10 classes where we're going to cover up all the standards of business combination, then Indies 110, 111, and 28, 27. So all the plethora of consolidation standards, and then it'll be followed by the financial instrument standard as well. So that's going to be a long journey, but this is going to be a very scoring part in the exams as well. Right, friends. So I think that seems to be good enough. I think let's see if you're getting some more questions further. And I'll be uploading these notes also very soon after the class out here. Nivetal, so step model makes understanding very much easy. Thank you, Nivetal. Thank you so much. And Abhijit, sir, studied advanced accounting from you, never looked back. Thank you, Abhijit. Thank you so much indeed. And Shruti, thank you so much. It was a very nice, detailed, well-explained lecture. Thank you so much, Shruti. Thank you, all of you. It was indeed a pleasure. So see you in the next class, and please do revise. I'll join you in the next class. Thank you, all of you. Bye-bye, and take care.